15 seconds to live. And 10 seconds to live.
Hello, I'm Rebecca Spence with the press office at the Bank of Canada. Bonjour tout le monde. Welcome to the Bank of Canada and the press conference following today's interest rate announcement. Le gouverneur Macklem va prononcer sa déclaration préliminaire. Ensuite, on va tourner aux questions des journalistes. After Governor Macklem's opening remarks, he and Senior Deputy Governor Carolyn Rogers will be pleased to take questions until about 11:15. Over to you, Governor.
Thank you, Rebecca, and good morning. I'm very pleased to be here with the Senior Deputy Governor to discuss our monetary policy decision. Today, the Governing Council maintained the policy rate at 2.25%. We have three main messages. First, steep U.S. tariffs on steel, aluminum, automobiles, and lumber have hit those sectors hard. And uncertainty about U.S. trade policy is weighing on business investment more broadly. But so far, the economy is proving resilient overall. Second, inflationary pressures continue to be contained despite added costs related to the reconfiguration of trade. Total CPI inflation has been close to the 2% target for more than a year now, and we expect it to remain near the target. And third, in the current situation, Governing Council sees the policy rate at about the right level to keep inflation close to the 2% target while helping the economy through this period of structural adjustment. Nevertheless, uncertainty remains high and the range of possible outcomes is wider than usual. If the outlook changes, we are prepared to respond. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,25%. Nous avons trois messages clés. Premièrement, les droits de douane américaines élevés sur l'acier et l'aluminium, les automobiles et le bois d'œuvre ont porté un coup dur à ces secteurs. De façon plus générale, l'incertitude entourant la politique commerciale des États-Unis pèse sur les investissements des entreprises. Mais jusqu'à présent, l'économie se montre résiliente dans l'ensemble. Deuxièmement, les pressions inflationnistes sont encore contenues malgré les coûts supplémentaires associés à la réorganisation du commerce. L'inflation mesurée par l'IPC global est proche de la cible de 2% depuis plus d'un an et on s'attend à ce qu'elle y reste. Et troisièmement, le Conseil de direction considère que, dans la situation présente, le taux directeur actuel est essentiellement au niveau approprié pour garder l'inflation près de 2%, tout en aidant l'économie à traverser cette période d'ajustement structurel. Mais l'incertitude demeure élevée et l'éventail des issues possibles est plus large que d'habitude. Si les perspectives changent, nous sommes prêts à réagir. So let me expand on how we're interpreting new information, the new information we received since we published our October monetary policy report. In November, Statistics Canada published broad revisions to Canada's economic growth numbers for 2022, 23, and 24. The revisions suggest the Canadian economy was healthier than we previously thought before we were hit by the U.S. trade conflict. In particular, they suggest both demand and economic capacity were higher coming into this year. This may explain some of the resilience we're seeing in more recent data. After falling 1.8% in the second quarter due to sharply lower exports, Canadian GDP grew 2.6% in the third quarter. This was much stronger than we expected, but largely reflected volatility in trade. Final domestic demand was flat in the quarter. We expect growth in final domestic demand to resume, but with an anticipated decline in net exports, GDP growth is likely to be weak in the fourth quarter before picking up in 2026. The labor market is showing some signs of improvement. After declining through the summer, employment has posted solid gains for the past 3 months, and the unemployment rate has declined to 6.5% in November. Since the start of the year, there have been significant job losses in trade-sensitive sectors, but in recent months, employment in these sectors has been more stable, so gains in other sectors, particularly services, have boosted overall employment. Looking ahead, however, we're seeing muted hiring intentions across the economy. Inflation has evolved largely as expected. CPI inflation was 2.2% in October, and measures of core inflation remain in the range of 2.5% to 3%. In the months ahead, we will see some choppiness in headline inflation, reflecting the temporary GST-HST holiday a year ago. This is likely to push inflation temporarily higher in the near term. Seeing through this choppiness, we expect ongoing economic slack to roughly offset cost pressures associated with the reconfiguration of trade, keeping CPI inflation close to the 2% target. The recent federal budget includes increases in government spending, particularly in defense, and measures, the recent federal budget includes increases in government spending, particularly in defense, and measures to increase public and private sector investment. It will take some time for the impact of these measures to be fully realized, and we expect they will contribute to growth in both demand and supply in the economy. As usual, we will incorporate updated fiscal measures from federal and provincial budgets in our next economic projection in January. Taking all these developments into consideration, Governing Council assessed the stance of monetary policy. After cutting the policy rate in September and October, Governing Council had indicated that if inflation and economic activity were to evolve broadly in line with the October projection, the policy rate would be about right. While information since the last decision has affected the near-term dynamics of GDP growth, it has not changed our view that GDP will expand at a moderate pace in 2026 and inflation will remain close to target. Governing Council therefore decided to hold the policy rate unchanged. We agreed that a policy rate at the lower end of the neutral range was appropriate to provide some support for the economy as it works through the structural transition while keeping inflationary pressures well controlled. Finally, Governing Council acknowledged that uncertainty remains elevated. This includes the unpredictability of U.S. trade policy, and in particular, the upcoming review of the Canada-U.S.-Mexico agreement is creating uncertainty for many businesses. There's also uncertainty about how the Canadian economy will adjust to higher U.S. tariffs. The volatility we're seeing in trade and quarterly GDP make it more difficult to assess the underlying momentum in the economy. Nous allons évaluer les nouvelles données par rapport à nos prévisions. Si un nouveau choc ou une accumulation de données vient changer nos perspectives de façon importante, nous sommes prêts à réagir. Les frictions commerciales accrues avec les États-Unis vont entraîner pour notre économie une perte d'efficience, des coûts plus élevés et des revenus plus bas. C'est plus qu'un ralentissement cyclique. C'est une transition structurelle. La politique monétaire ne peut pas rétablir l'offre perdue, mais elle peut aider l'économie à s'ajuster tant que l'inflation est bien maîtrisée. La priorité de la Banque est de préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversements mondiaux. We will be assessing incoming data relative to our outlook. If a new shock or an accumulation of evidence materially change the outlook, we are prepared to respond. Increased trade friction with the United States means our economy works less efficiently with higher costs and less income. This is more than a cyclical downturn. It's a structural transition. Monetary policy cannot restore lost supply, but it can help the economy adjust as long as inflation is well controlled. the Bank of Canada is focused on ensuring Canadians continue to have confidence in price stability through this period of global upheaval. And with that, we'd be very pleased to take your questions.
Thank you, Governor. We'll start with questions here in the room and then go to reporters who are joining us remotely. As usual, please limit yourself to one question so that we can get to every media outlet. Before asking your question, kindly state your name and affiliation. Avant de poser votre question, prière de vous identifier. Libre à vous de poser vos questions dans la langue officielle de votre choix. We'll start with Mark.
Thank you for taking the question, Mark Reynolds with Globe and Mail. Wondering about the labor market. We've had 3 strong reports in a row. You seem to be downplaying that a little bit, talking about weak hiring intentions, trade-sensitive sectors being hit. And so I'm just wondering how we should be thinking about how you're thinking about those 3 strong reports in the state of the labor market right now.
Well, look, first, Mark, I mean, we're pleased to see the improvement in the labor market. And as you said, we've had, three reports with important job gains. The unemployment rate has come down to 6.5% in November. It's ticked down through the last 3 months. Pretty big move in November. So look, that is encouraging. And I mean, if you look at what's going on in the labor market, we saw some big job losses in the summer. Those were concentrated in sectors sensitive to trade. Through the fall, employment in those sectors has been relatively stable. It's still weak, but it hasn't weakened further. And at the same time, we've seen some hiring, particularly in services, things like healthcare, personal care, recreation, and that's flowed through to the bottom line. So you're seeing overall employment has moved up. So that is encouraging. There is some resilience to the economy. What I would say, though, is, looking forward, it hasn't fundamentally changed our view. The Canadian economy is going through a difficult structural adjustment. That is going to take some time. When you talk to companies, they're being very cautious about their investment plans. They're cautious about their hiring plans. So yes, we are pleased to see this resilience, but going forward, we continue to expect fairly modest growth.
We'll go next to Promit.
Hi, Promit from Reuters. Governor, taking it further, I mean, what is the source of this resilience in the economy? I mean, considering that we have tariffs and we have uncertainty about USMCA, why is this resilience coming from? Where is the resilience coming from?
Look, it's a good question, and it's going to be hard to give you a super precise answer, but I think there's a few things I would point to. First of all, as I mentioned in the opening statement, there were broad-based revisions to the national accounts covering the last 3 years, 22, 23, 24. And what you saw there is that demand was stronger, consumption, consumer spending was stronger. But the other thing you saw is that business investment was stronger, and productivity growth, while still weak, went from 0 to about 0.5. So, both demand and supply were stronger. So as we came into this year, the economy was healthier than was previously reported, and that may be explaining some of the resilience we're seeing in the more recent data. The second thing I would point to is that we have very steep tariffs on some key sectors in our economy: steel, aluminum, autos, lumber. But for the rest of the economy, it continues to operate largely tariff-free with the United States. If you're compliant with CUSMA, outside of those sectors, you're still operating under the Canada-U.S.-Mexico trade agreement. So, I mean, Canada's actually, as significant as these tariffs are, Canada's average, the average tariff rate on Canada from the United States is one of the lowest in the world, about 6%. So what you're seeing is, those sectors have been hit hard, but we haven't seen big spillovers to the rest of the economy. We're seeing some, so overall, the rest of the economy is showing some resilience.
We'll go next to Kevin.
Good morning, Kevin Carmichael from The Logic. Governor, you've had some time to sit with the federal budget now. To what extent do you think that's going to provide an offset to the tariff headwinds and everything else that's happening with global trade?
Well, as you know, I don't have an updated forecast for you, but you're right. We certainly have been looking at the federal budget. We will take those measures along with, there's also been some provincial budgets, and we'll build those into our revised outlook that we published in January. What you see in the budget is there's some increases in government spending, particularly on defense. That'll support demand. There are a number of targeted measures. Actually, a lot of those were announced before the budget, but they're in the budget to support those hard-hit sectors I just mentioned. Some of those, and a lot of those are to try to help those sectors pivot to domestic sources of demand, or to pivot to exporting to other countries other than the United States. And then the other important element of the budget is there's a lot of focus on investment, both public investment, big infrastructure projects, and stimulating private investment. I would say two things about the budget. We're still working through the macroeconomic implications, but I'd say two things. One is it's going to take some time for the impact of those measures to be realized. I mean, first of all, it takes time to actually get the money out the door, to get those projects going, and then it's going to take time for those to show up in the economy. And that'll build up over time, but it's not like there's a big hit right away. The second thing is, the impact's going to depend importantly on the speed and the effectiveness of the execution, and importantly, particularly on investment, it's going to depend on the uptake from the private sector. So, I mean, those things, we're going to have to come up with some forecast of those things. And then the final thing I'll say is that, the budget is going to add to both demand and supply. We'll have to work out the relative balance there. But, to the extent that it's adding capacity as well as demand, it's not adding a lot of additional inflationary pressures.
We'll go next to Paul.
Governor, do you think traders are getting ahead of themselves in pricing in rate hikes in the second half of next year?
Paul, I'm going to let traders decide what trades they want to make. What can I say? I think we've been pretty clear that we think the policy rate, given how we see things right now, we think the policy rate is right. In the sense that we think it's about right to keep inflation close to 2%. And, given that we're at the lower end of our neutral range, providing a little bit of support to the economy to help it work through this structural adjustment. That's how we see things now. How we see things going forward, well, that's a more difficult question, and I'm not going to put our policy on a timeline. I think what markets can count on is, we're going to take our decisions one at a time based on the best available information, and as our views evolve, we will update Canadians, we'll update markets. The other thing, I would point markets to is, we're going to be assessing incoming data relative to our outlook. And we'll be doing that in a symmetric way. If our outlook changes material in either direction, either because there's a big shock or because there's an accumulation of evidence one way or the other, we're prepared to respond.
We'll go next to Jordan.
Good morning. How concerned are you about the reliability of GDP coming out of Statistics Canada, given the revisions to GDP in recent years, and you spoke about the volatility in quarterly data as well moving forward. So what ramifications does that have for monetary policy decisions if you're not getting a full picture of growth until after the fact?
Well, you know, I would underline Statistics Canada has a very tough job. And, anytime you've got a lot of volatility in the data, that job gets harder. It has been compounded by the fact that you wouldn't think that the U.S. shutdown would really affect Canadian data, but in fact it does, because there are a number of bits of data that actually Statistics Canada gets from the U.S. The most important one being our exports to the United States are collected at the U.S. The data for that's collected when they get imported in the United States. Similarly, we send the U.S. imports into Canada into the U.S. So with the shutdown, the data on exports is not as good as normal. Statistics Canada does have some other indicators, so they've made their best estimate. But yes, it does. In the fullness of time, when U.S. data comes in, yes, there is a prospect of some larger than normal revisions. So yes, that does. You do need to look at all the indicators and try to sort of look through and see where's the underlying momentum, and revisions could make that a little more complicated. But fortunately, the U.S. shutdown is over. That will pass. We will work our way through it.
We'll go next to Annie.
Hi, thank you for taking our questions. The bank often talks about inflation returning to target, but a lot of Canadians who are listening to this don't care as much about inflation rates. They care about costs. So how does your current policy rate take into the fact that prices remain historically high and wages aren't keeping pace? And what do you say to Canadians who are struggling with affordability this Christmas?
Well, it's a very good question, and I think we might take this one together, because it is such an important question, and we're hearing the same thing from Canadians that you're hearing. I'd say a couple things. First of all, inflation has been around 2% for more than a year now, but as you indicated, as we came out of COVID, inflation was much higher. Prices went up. And inflation's come back down, but prices have not. So yes, many Canadians are feeling squeezed by the cost of living. What I would underline is two things. One is it underscores the importance of keeping inflation low, so that incomes can catch up. The other thing I would stress is that we're not going to lower prices overall. That's not how, if we were to try to push the whole price level down, that would cause a severe recession in Canada. Nobody wants that. So we're not going to become, things are not going to become affordable by lowering prices overall. The other element, we need to keep inflation low. The other element to improving affordability is to grow income. And how do we grow income? Well, we need to improve our productivity. We need to invest more. We need to diversify our trade. That's what's going to grow income. With more income, then everything becomes more affordable. But do you want to say a few words about sort of what we're hearing from Canadians and some of the discussions we've had?
Yeah, I mean, we have significantly stepped up our outreach to Canadians in the last 2 years. And we're hearing the same thing that you described. I mean, the CPI, the 2% CPI measures the rate of growth of prices. It doesn't measure the level change in prices that has happened as a result of CPI being higher than our target in the past. And Canadians are still feeling that. The other thing they're feeling is that where prices are still under a bit of pressure is food and shelter, things that you really can't avoid. So those things loom large for Canadians. We understand that. We don't target, as the governor said, we don't target any one price. We target the overall rate of change in prices. That doesn't change that level shift feeling that Canadians are dealing with still. But as the governor said, what we don't want, although it sounds good, the idea of prices coming down, that happens when the economy is struggling. So what we need to do is keep inflation at target and support the structural shift that the economy is going through. As the economy grows, it will support wage increases, and that will help over time fix that sense of affordability being tough for Canadians.
We'll go next to Najud.
Hi, Governor. I know you don't have a new forecast for the economy, but given the recent data, and as you say, showing that the economy is potentially more resilient right now, do you think that there's less slack in the economy than you forecasted in the October NPR? And relatedly, do you see the output gap narrowing over your projection horizon because you continue to have an output gap through till 2027?
Okay, well, as you started, we don't have a new projection and we don't have a new estimate of the output gap to go with that projection. But let me say a few things. I mean, look, the bottom line is, the recent data, as we've discussed, is showing some improvement, and that is welcome news. But it has not changed our view that the economy is still in excess supply, and we continue to expect modest growth going forward. So, what are the what are some of the data that you would look at as you assess the balance between demand and supply? Well, as has come up already, Statistics Canada published new, pretty broad revisions to the national accounts, and they showed and that was for the last 3 years, they showed GDP quite a bit higher. And if you look at why GDP was higher, it's both demand, particularly consumption was a lot stronger, but there are also important supply elements. Investment, productivity was also higher. So I would not interpret the higher GDP as simply an indication of more demand. I think there's both demand and supply elements to that. They're both stronger, and we'll have to be we'll have, before we get to January, we'll have to make some assessment there of the overall balance. The second thing I think people are looking at is the third quarter. It came in much stronger than we expected. We were monitoring 0.5. It came in at 2.6. And so, just sort of mechanically, that means the output gap is smaller. Again, though, I would underline that if you look at the details of Q3, it doesn't look like an indicator that demand in the economy was a lot stronger. I mean, Q3 was strong largely because imports were really weak. Final domestic demand was actually flat. And looking ahead to the fourth quarter, we actually think final domestic demand will pick up a bit, but we expect to see a further swing in trade. So we're expecting Q4 to be weak. So you put it all together. Look, I think you put it all together. The resilience we're seeing in the Canadian economy is welcome news, but it hasn't really changed our view. We still think the economy is in excess supply. We still think growth will be modest, because the economy is working through a structural transition. That's going to take time. And so, we still see that slack being taken up pretty slowly.
We have a couple more questions in the room before we go to the phone. So we'll go next to Greg.
Good morning. I want to return to Promit's question about, tariffs and the influence on your policy. And I think of three elements. Firstly, investors thought we were almost guaranteed to have a recession. That appears that it hasn't happened. The secondly now is the idea that central bankers sometimes like to keep their powder dry in case there's another shock that could be related to trade. Wonder if that's in your thinking. And thirdly, you've also said that fiscal policy or government policies are better than monetary policy at helping affected industries, which could suggest that if Trump breaks another trade deal with Canada, you know, the pecking order is maybe set more on the government side. So can you elaborate on how these tariffs, shocks, and threats have gotten you to this point, and what, more importantly, like how it might influence you next year?
Yeah. I don't know where to start on that one, Greg. You packed so much into that question. You know, look, let me sort of just try to sort of review, I would say, what, you know, our thinking and how it's evolved. I mean, I think, you know, the first message is that, yeah, it's been a difficult year for Canadians and Canadian businesses. But, you know, it's looking, as the year's closing, it's looking a little better than it looked in the spring and the summer. You know, to sort of walk you through that, you remember the spring in particular, President Trump threatened, then imposed, then retracted, then reimposed tariffs. You know, as I as I have already spoken to, you know, fortunately, the average tariff rate that Canada faces with the United States is among the lowest in the world. We've got some sectors that are hit really hard, but outside of those sectors, you can still trade largely tariff-free with the United States. And yes, you know, through that spring and summer period, yeah, the R word people were talking about was recession. And you know, we published scenarios where with you know, there were certainly scenarios for U.S. tariffs that could have pushed the Canadian economy into recession. You know, since then, I would say, you know, now at the end of the year, as we get to the end of the year, you know, the R word people are talking about is resilience. We've seen some improvement in the data. You know, the last three employment reports posted solid gains. Q3, the economy expanded. So, you know, we're certainly, I think, you know, ending the year in a better place than it looked in the middle of the year. But, you know, we've still, there's still a significant adjustment to work through. So, yeah, I would say, you know, that's how we're seeing it. You're right. You know, a number of things play into this. We're going to be assessing, you know, the impact of the budget in February. But, you know, that's really I think that's the sort of the best way I can lay out how things have evolved over the last year.
We'll go now to Mackenzie.
Hi there. Both of you have previously said that when the TMX pipeline expansion came on, that you estimated that it would give about a 0.25% increase to the Canadian economy. In your estimation, if there's a new oil pipeline built to export oil to Asia, would there be a similar increase to the economy? And Governor, you just mentioned in your response to Annie that you think it would be wise to diversify the Canadian economy. So do you think building a new oil pipeline to diversify oil sales to Asian markets would be a wise decision?
Well, look, I'm not going to comment on any specific plan, and I certainly don't have an estimate of you know, the impact of that of this plan of a plan on the Canadian economy at this point. But you know, yes, we do need to diversify our trade, and I think, you know, the TMX pipeline expansion has been an important example. It has allowed us to increase our exports to non-U.S. And, you know, if you look at, you know, I don't have the exact numbers in front of me, but, you know, it's gone from something like, you know, 98% of the U.S. to 95% of the U.S. So it's not a huge shift in our total exports, but, you know, on the margin, it's helping us get more oil to other countries, and it's also helping us get more value out of every barrel we estimate, because the spread between the Western Canada Select and WTI has been narrowed by TMX. So yes, it is a good example of how these things can really make a difference. We do need to diversify our trade, and part of that is better east-west transportation, better port capacity to get our products to the rest of the world. And yes, part of that is pipeline capacity.
All right, we have a few reporters on the line with us. I just want to remind those on the call to mute your line if you're not asking a question so that everyone can hear the responses. We'll go first to Mace News, followed by Yahoo Finance, and then Mortgage Logic News. So go ahead, Max.
Thank you, Rebecca. This is mainly for the governor. Not just Canada, but other major economies are also going through a structural transition, and some central banks are now discussing raising policy interest rates for different reasons. For example, the Reserve Bank of Australia possibly in February, as the inflation rate is above the target range, and the Bank of Japan probably next week as part of the normalization process, citing reduced uncertainty over the U.S. tariffs and negative rates still. And so, compared to those economies, is Canada's exposure to the U.S. trade policy still much more serious? And you mentioned the average 6% tariff rate for Canada. And are we still many months away from the need to even look at the possibility of adjusting the rates slightly higher?
Well, I don't really have much to add on rates. I think I've been pretty clear. We think, based on how we see things now, we think policy rate is in the right place. There's a lot of uncertainty that could change going forward, and we'll be updating you. On the impact of tariffs, yes, I would say one thing. In Canada, so most countries trade with the United States, Japan, European Union, they trade with the United States. What's different about Canada is that in Canada and the United States, we build things together. We have not had, we've had free trade, open trade with the United States since 1989, it's 36 years ago. We've had open trade in the auto industry from going back to 1965. And the consequence of U.S. tariffs is it's disrupting that whole business model. So yes, it is having a big impact on our economy, even though the average tariff rate is quite low. And it, as I've underlined, it's not just a cyclical adjustment, it's a structural adjustment, and that's going to take some time.
Go ahead, John.
Hi there. Thanks for taking our questions. Back in October 2024, you said Canadians could breathe a sigh of relief as inflation came down. And so we're a year and a half into a cutting cycle, or at the end of one, but many Canadians are still worried about the economy, about their jobs, about their ability to buy a house or sell their house. With all the uncertainty you've highlighted through this year, what's your message to Canadians at the end of 2025 and going into 26?
We might take this one together, but you go ahead.
I mean, it's a tough message. As we said earlier in response to a question, we know when we talk about inflation being back to 2% and how that's a good thing and that should help relieve some pressure for Canadians, that doesn't tell the whole story for them. They're still dealing with higher prices than a year ago or 2 years ago. They're dealing with the constant threat of an escalation in the trade war with our largest trading partner. And despite the fact that the economy has proven resilient, there is a sort of an overwhelming feeling of uneasiness or uncertainty that I think hangs over Canadians right now. So we're acutely aware of that. The one thing that we will continue to focus on and continue to contribute to that picture for Canadians is to keep inflation at target. It's not going to bring prices down. We know that. We talked about that earlier. But it is a source of stability that we can add to a very uncertain picture.
We'll go next to Robert.
Good morning. You mentioned you'll be updating people as the bank's rate outlook changes. I'm wondering if we could drill down on that a little bit. And the reason I ask is because in the months leading up to the steep 2022 hikes, over half of Canadian mortgagers were still taking variable rates, and it caused a lot of unnecessary pain. And so I'm wondering, like, can you talk about whether it's the bank's policy to warn the public as soon as it believes there's a materially higher probability of rates going up versus staying the same or falling?
I mean, our policy is to call it as we see it, and as our, that's partly why we put out an economic outlook. This is when we put out an outlook, it's because that's our best assessment of where the economy is going. We know we need to be humble about that outlook. We know there's a lot of uncertainty. We know the situation could change, but we put that out because that's monetary policy has to be forward-looking. We're putting that outlook is because that's the basis, along with the risks that we're using to take our monetary policy decisions. And then the second thing is we're going to be assessing the data relative to that outlook. So, I mean, even before you hear from us, if you can see the data that is coming in a lot stronger than the outlook we've published, you can be assured that we're asking ourselves, we've noticed that data's coming in a lot stronger. We think that's going to be sustained. Is it temporary? Is it more lasting? Is that materially changing our outlook? And as I said, as our views evolve, we will be updating Canadians. I'm not sure. Yeah.
The thing I'd add to that, Robin, you know this well, you've written about it, is Canadians choose their mortgage terms for a variety of reasons. The path of rates is one of those reasons. So as the governor said, it's our job to be really clear about where we see the economy going and how that's affecting our decisions. At the end of the day, it's the job of mortgage brokers and other financial advisors to take that and other things into account as they advise clients about their mortgage terms and conditions.
All right, and our final question will be from the Canadian Press. Ian, go ahead.
Thanks for squeezing me in. Just on, you mentioned shelter costs still being elevated. Can you update kind of where you're seeing shelter costs going next year and how concerned you are about the kind of final wave of mortgage renewals?
Yeah, I mean, it's tough to talk about Canada's housing market in at a national level right now because there's a lot of regional differences. But I think generally we would say we see better balance in the housing market. Sales to new listings looks pretty balanced. Prices have come off their highs at a national level. They've come off their highs and look to be stabilizing. Overall activity looks to be better balanced right now. But again, that national picture masks some more imbalanced markets in sort of some regions and some housing types. So I think in general, we don't expect another surge in house prices. We do expect maybe a continued correction in some of the higher price markets. Overall, both interest rates and supply conditions are helping to improve affordability on the margin, but we've got a ways to go. We've got a structural housing supply issue in Canada, and really until we address that, I think there'll still be pressure on affordability, particularly for first-time home buyers.
That concludes today's press conference. Thank you, Governor, Senior Deputy Governor, and all of you for joining us. Merci et bonne journée.
Thank you all.
Happy holidays.
It's been quite a year. Enjoy the holidays and Happy New Year. Thanks.
All right, that was the Bank of Canada and their rate announcement and the press conference. I hope you leave your comments, your thoughts on the subject, and we will be back. Have a good morning.